Here's how to build a great and profitable trading strategy. My name is Evan Scales. I'm the founder of NQSignals.com. We use AI to analyze our charts and tell us what to do next in various intervals of time. I've also personally taken about $100,000 of my own cash and scaled that up over $700,000 in just under 2 years using these very same principles. So I'm going to share with you what I believe is true about building a profitable trading strategy. I will certainly leave some things out because maybe I don't align with the way you think about it, but let me know in the comments if I missed anything and we can touch on it in a different video. So let's get right into it. Now, the number one thing that you have to understand when you're looking at building a trading strategy is you have to account for losses. And it'll feed right into this next point, which is you have to treat trading like a business. Let's use like an apartment building as an example. Let's say you have an apartment building and you have 2 floors in this 10-floor building. On the first floor and the 5th floor where there is washer and dryers, okay? And imagine you have a flood on your 5th floor washer and dryer, and it floods down into your 4th, 3rd, and 2nd floor, okay? And you have a ton of maintenance that you have to do. A lot of traders look at their strategy, like this apartment building, and say, you know what, I'm gonna sell it. I'm gonna sell this building because it has too many expenses. When in fact, you should have just accounted for those expenses when you originally went and bought the building, okay? When you have losses, like that's part of the game, okay? You don't treat this like a hobby, it's a business. Any business has profit margin. That means that there is revenue, there are losses, and ideally what's left is profit, okay? The other thing you have to do is you have to learn from your losses and then adjust, and we'll talk about that a little bit later. Let's get it going though. Now, the first thing you have to really decide once you know that you want to day trade or swing trade or whatever is what type of trader do you want to be? And I kind of gave away where we're going with this, right? Do you want to be a swing trader, okay? Or do you want to be more of a scalper / day trader? Now, being a swing trader, it comes with its benefits, okay? You've got bigger wins, you have bigger losses, and you have less trades. This would be good for somebody who doesn't have as much time to trade. You don't have all day to look at a computer screen. You're like, you know what, I want to take 1 to 2, maybe 3 trades a week, maybe a little more, and I want to hold them for a significant chunk of time, and I'm thinking that I can make a huge amount of profit if this thing moves the way I want it to, okay? Now, you're going to have a lower win rate because you have bigger moves. You're going to have less trades. You're going to need to be more accurate, and there's going to be more analysis. So even though you'll be looking at your screen less, you'll still need to do the same, if not more analysis to find these moves because they won't all be created equal. Okay, so when you're a swing trader, you're looking for big moves, very simply, but you also want to be really accurate. And typically you're going to allocate more money to these trades because they're taking fewer of them, all right? Go over to the day trading scalper side. You're taking smaller trades, smaller wins, you're having smaller losses, but you're taking a lot more of these trades, okay? So it's kind of like you're trying to do the compounding effect of small, 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 but over time, your pot grows, okay? And when you think about it like this, you're gonna need a higher win rate. So when you scalp, you're gonna need to win more times than you lose, which is really important. We'll get into that later as well. And you're gonna need a little bit less analysis. And the reason for this, and I'm not saying you to be careless, but what I'm saying is when you scalp or you day trade, you're taking more trades. And so every single trade doesn't have to have the same amount of huge analysis. You really only need to do a little bit point in time because the moves you're going for are pretty small. By the time you're 100% sure something's going to happen, it's probably over, it's gonna reverse on you and you're gonna lose. So when you're scalping, you're gonna go and be a little bit more aggressive with your trades. When you're swing trading, you can actually be a little bit more patient and be a little bit more sure. What that's going to allow you to do is see moves that hopefully have a ton of momentum behind them. Hopefully you can build into that, all right? So you have to decide which one you wanna be, a swing trader or a scalper. That'll be kind of up to you. Now, the first thing you have to understand about building a great trading strategy is you need a primary confirmation. Now, this can be hundreds and maybe thousands of things, all right? We'll talk about 2 primary things. I think everything kind of falls into these 2 buckets, but it could be literally anything you want it to be. And so I think it's really important that we break it down in just these 2 ways. The first way is price action, all right? So you're gonna use price action, and the second way would be indicators. We'll talk about both here. But you're gonna use price action if that's the path you go down to find your trades, and we'll unlock kind of all of these. All right, but you're only going to read the charts, you're only going to read candles and patterns. So you're looking at what does the chart say, what are these patterns, like what are these trend lines, what is everything that I'm seeing actually saying to me to make a trade, all right? You're gonna find your primary setup. This is something that when people trade candlesticks and they trade price action specifically, they have like 15, 10, 8, 5 different ways that they wanna look at taking a trade. You need to find the one way that you want to trade. What type of setup, what type of candle structure do you want to see on multiple time frames or just one time frame? That's going to allow you to have a really good entry and hopefully a really good and profitable trade. Now, What this does when you focus on price action, I think, is it simplifies your entries. You know what you're looking for. Like every trade should look very similar. Like, okay, price is going like this, and then price comes down. I want to take a long trade off of this and let the continuation keep going, or vice versa. Like you know what you're looking for. The problem with it is you have to wait a little bit longer for trades. And so individuals who want to maybe swing trade, you have to do one of two things with this. Number one is you either have to scan a lot of assets to look for your setup, or you just kind of have to wait and try and set alerts for what you're hoping to see, and then you can take a trade. And things don't always happen on your schedule, as you probably already know that. So this is the only downside to trading with price action. I mean, there's some other ones, but like this is a big downside, is typically people add multiple different entries and different strategies for price action because the ones they're waiting on just don't happen as frequently as they would like. And so that kind of makes them impatient, so they add more, and that's kind of why they lose. All right, so that's the price action side. We could spend an hour on price action and on indicators, but I just want to sum it up into what I think a couple like benefits are, and then what I think maybe some downsides are. Now, with indicators, you're only going to read the indicators. All right, so you're only looking at just MACD, super trend, squeeze momentum. You can look at, pivot points, like pick whatever indicators you want to use. And when I say indicators, this could also be like you're using some sort of option flow. You're using some sort of like data, level 2 data, where you're trying to find certain things. Like you're using something that is telling you what to do. Price action, you're using candles to look at what to do. An indicator is basically something that tells you kind of what to do based on some other analysis. InQSignals.com is an indicator. Okay, it reads price action, but it is telling you to go long or to go short based on the analysis. That's what an indicator is. It kind of makes the decision for you, and then you choose to ignore it or accept it. Now, what you're looking for with your indicators, and just your primary indicator, or one or two of them, is going to be alignment. So I'm thinking about this like the RSI as an example. Okay, if it's overbought, then you're looking for price to eventually start to curl a little bit, and you want to take a sell as price comes back down. Or you're looking at the Bollinger Bands, price gets outside one of the Bollinger Bands, you want to go ahead and take a trade back inside to the Bollinger Bands. You're looking for the proper alignment. Now, what indicators do is they reduce the amount of candle noise, and so typically they do a good job of like filtering out the wicks up and down, filtering out a lot of the choppiness. Typically, your indicators will give you like a middle of the reading / like nothing's going on type of direction, which will really help you not take like shady trades, to be honest with you. Like you're not going to take a ton of really bad trades. But the thing about indicators is not every single trade is going to look alike, right? So with price action, you get the same setup, ideally the same setup every single time. With indicators, you're going to get the same indicator alignment every single time, but price action will look different. And so this is where indicators can be a little tricky for some individuals because not every trade is going to appear exactly the same, right? So you kind of have to figure out which one is better for you. I think they both have positives. InQ Signals, the AI that we use, analyzes price action and indicators. We've combined them, okay? So I don't know that one is better than the other. It just comes down to how you see things and your personality. Again, one is not better than the other. People make millions of dollars trading indicators. People make millions of dollars trading price action, okay? So either way. All right, now, once you get past your primary confirmation, you're going to get into your secondary confirmation. And I think a lot of traders kind of just stop right here. They don't get past the primary. They just only focus on one thing. You have to have a second thing. So let's kind of touch on this for a second. Your secondary confirmation can be, but ideally, indicators or price action. So ideally, what you want to do is like focus on price action, filter with indicator, okay? Or start with indicators and then filter out with price action. Now, what ends up happening with this is you're trying to do one of two things with your secondary confirmation. And this is something that took me a long time to understand, but once I got it, I really, really got it, okay? Let me just check something while I'm recording here. You guys can see everything. All right, cool. So your secondary confirmation is going to filter out fake outs, okay? Or you're going to enter later. What this typically means is you have price sloping up, okay, as an example, but maybe it's coming off of a huge downtrend. Your secondary confirmation in one of two ways can either be really quick or it can be really slow. But what that's trying to do for you is like price is coming down, it goes up like this, and price is going to continue to go like this. Your secondary confirmation should tell you, hey, don't enter this upward move, like just wait, and as price curls back down, now you're back in alignment with your primary confirmation, and boom, you take that trade. Same thing going up or any other way you want to trade. Support, resistance, doesn't matter. Okay, but you're typically going to try and like avoid the fake outs, and this is typically going to have you entering a little later on trades. Now, if it's a real move, if this is like exactly what you're looking for, then you'll be totally fine. Like if it's an actual move that's moving and its price is going up or price is going down, then you waiting a couple candles won't be a huge deal. If it's a real move, it will just continue to go and you'll be able to profit from that. But your secondary confirmation is going to make you wait before you actually enter a trade. Now let me pause this while the long guy cuts my lawn. I'll be right back. All right, I think we're in the clear. Let's keep going here. All right, so once you figured out like your secondary confirmation, again, it could be the opposite of what you use as your primary. It could be the same exact thing, honestly. It doesn't really matter. But you need to have two things that you're looking at, that one says you're good to go and one says maybe not yet, or the move's over. You want to have something that tempers you from taking too many trades, even if you are a scalper, right? You want to have something that helps you stay out of taking really bad trades. Now, let's move on to the next part, which is simply your stop loss and take profit. This is huge. This is everything. This is, if you just get the stop loss take profit correct, and we can talk about trailing stops in a later video, but if you just get this right, you can manufacture wins and manufacture profit. It really is like this simple. Getting this right is the most important part. You can almost skip through everything that we talked about so far if you just get the take profit and stop loss correct, okay? So let's break down kind of how I see take profit and stop losses, and we'll go from there. The first thing you have to decide is what style fits you, and I'll unlock all three of these so you can kind of see them. But there's a 1-to-1 risk reward ratio, there's a 1-to-2 risk reward, and there's a 2-to-1 risk reward as well. You have to figure out which one of these styles fits you and your strategy the best. If you're a scalper, you can kind of get away with a 1-to-1 or a 2-to-1. Okay, so a 1-to-1 would be like, I jump into a trade, we're talking about futures right now, I take a 10-point take profit and a 10-point stop loss, all right? Or I take a 10-point take profit and a 20-point stop loss. That typically ends up working out pretty well for individuals who scalp. If you're looking for longer trades, a 1-to-1 can make sense because ideally if you just get a couple trades right, one wrong, you still have some profit. Or you could do a 1 risk and a 2 reward. So this would be like 100 points of stop loss, 200 point take profit. So you really don't need to win that many trades, and we'll get into that actually. So let's talk about what you need to break even and then have success. For the 1-to-1, obviously you just need a 52% win rate. Usually it's like 51, but I want to account for some commissions in there, so 52% or so. With a 1-to-2, so you're risking 1 to make 2, you only need a 33.33 and change, or 33.6 and change, just round up to 34. You really only need to win about 1 every 3 trades to have success with this. It's kind of hard to do, but if you get there, it's actually pretty simple. You don't need to win that many trades. With a 2-to-1, you need to win way more trades because your wins are smaller than your losses. In this example here, the 1-to-2, your wins are double the size of your losses, and in this example, they're the same size, ideally. Now, figuring out how this works for you is huge and it's crucial. A lot of strategies will do very well with a 2-to-1, or a 1-to-1, or a 1-to-2, but you have to figure out what that is. A lot of times, people start with a 2-to-1 and they assume that's the best one for them. They're winning like 68, 69% of the trades, maybe even a little bit higher. But their strategy, if they went and analyzed it, could probably suit better at like a 1-to-2. They could squeeze out way more profit if they just took a little bit of that same risk. And so this is worth it, I think, to analyze and kind of like test on it, maybe spend a couple weeks trying each one just to see, because if you're at like a 49% 1-to-1, okay, that's not profitable, but it's pretty close. If you're at like 30% 1-to-2, not profitable, but kind of close. If you're at 66.5 or so, you're pretty close here. So you could like manufacture and change around your strategy, or like switch some of these around and see if maybe your strategy actually benefits and is better suited for something a little bit different. All right, so this is how I see it. Of course, you could go 3-to-1, you could go 1.5-to-1, you could go 1 to 1.5. I could mismatch or interchange them. Excuse me. You can interchange them however you want to do that. But for the most part, this is it. Like you either want your wins and losses to be the same size, you either want your wins to be double the size of your losses, or so, or you want your right here, or you want your losses to be double the size of your wins, but you can try to win more. This is the basic breakdown. Very, very simple. All right. Now, off of that, what we need to do is we need to stick to the same strategy for at least 2 weeks. And I know it's like a long time for some of you guys. Like 2 weeks can be a long time. I get it. But you don't really know. Throughout let's go 2 weeks. There's probably going to be 2, maybe 3 days of the entire 2-week span where price moves a ton. Like you get a huge movement. It's up or down, or it's both, right? Price is very flowy. And those days are going to be very easy to capture a ton of profit. Like you should make a ton of money on those days. If you only trade 1 day or 1 week at a time for each strategy, you might have a week where like you get 3 of those days in 1 week and your P&L looks crazy. Okay, but the second week, maybe it calms down and now you're a little bit more choppy. You got chopped out of some things and now you're like, okay, maybe the strategy isn't as good. So giving it 2 weeks will give you enough to see choppiness, will give you enough to see some trend, will give you enough to see some flow, enough to give you some like back and forth. Now it's fun to trade. Give it 2 weeks no matter what strategy you pick before you move on, because you're going to learn a lot. That's what we're going to talk about next, actually. So from here, you have to review your wins and losses every single day. This is like critical. If you don't do this, you don't really care about trading and you don't really care about your trading success. And a lot of you don't do this, and so that's how I know you guys don't care about your success. Like, you have to do this because you will learn a ton from your wins and your losses. So let's go down just one side from here. So the first thing, we'll talk about the losses first. Like, why did you lose? All right, and we can continue to go all the way down this thing here. But were you late or were you early to the trade? This is, like, to me, my favorite one to look at. Like, were you late to this trade or were you early to the trade? It's typically one or the other, right? If price, like, you get in and price reverses, you were late. If like you get in, price reverses a little bit, then it continues to go up, then you were just a little bit early. You can account for some of that with your secondary, okay, which is up here, or primary confirmations. You can figure out, okay, they're a little laggy, or they're a little too sensitive and it's causing me to get into trades a little bit too soon. You can account for that. All right. Was your stop too tight? This happens often too. Depending on the way that you trade, you might have a stop that's way too tight for the types of trades you're looking to capture. Why this would be interesting, let me pause it again for the long guy. We're back. I think we're in the clear now for good. All right, so your stop being too tight. This is interesting because you could have a mismatch between what you think you want to trade and what price is giving you or what your strategy is giving you. So let me give you an example of this. Let's say you have a 10-point stop on your strategy with a 15-point take profit. All right, well, you're winning like 25% of your trades. If you go and review them though, what you might see is that price does hit your stop and then continue in the direction that you thought it was going to go in. And so you might just need to like move your stop back a few points, which means you move your take profit up a few points to account for that, to keep that same risk reward ratio that you want to have. But a lot of times your stop might be a little bit too tight, and this could vary. And I'm experiencing this now, testing a few different strategies where like overnight my take profit stop loss too big, and then during like the AM when the market opens, take profit stop loss is way too tight. So like adjusting this over time can really help you, especially if you're trading at different times of the day: morning, midday, close, evening, early in the morning. Like, these kinds of things are really impactful. And if your stop is too tight, it will artificially lower your win rate, when in fact all you have to do is move it a little bit and you'll be in good shape. Keep going. So is your take profit too large? Kind of the same thing as we talked about before, but on the opposite side. So sometimes you'll be in a trade and like your take profit's here and price goes like this and then like reverses down. It's like, okay, holy hell, like that is ridiculous. If you go back and you review your trades, you might see that you have like 4 or 5 or 6 of these throughout the day that happen to you. Like, okay, so my win rate is, and we'll go back to up here to where our win rates were. Like, my win rate is like 49%, or it's 2%, or it's 65%. If I just account for my take profits being a little bit lower and adjusting my stop as well, I might be able to get over that hump and get to a profitable strategy. A lot of times it's that close. You just haven't tested it enough times. You haven't reviewed your trades enough times. Now, this is the other thing. This one hurts the most, but it's also worth like doing if you can, which is it better to like invert my strategy? A lot of times you guys would get into a trade, or me too. Like, I'm not saying you guys, just like a lot of times traders get into trades, okay, me included. And I'm like, damn, I should just hit sell instead of buy, or I should hit buy instead of sell. Sometimes your strategy will be tailor-made to catch like the very end of a move and then beginning of the next move. Take that into account. Don't be stubborn about like what strategy you put together about, oh, I use this strategy and this, I hope it wins because XYZ thing. Like, sometimes you get into trades and you're just like, man, I'm losing a ton. It's like, well, at some point when you click buy, you click sell, there is a right move and there's a wrong move. And if you're consistently losing a ton of trades, you're clicking the wrong button. So try and invert it. Okay, I see this thing lines up with this thing. Let me invert it and see what happens. Next thing you know, you start to be profitable. This happens to me a lot. It sucks because you think that you built a really good strategy when in fact the opposite thing you built is actually better, but still you built that, so have some pride in that. But at the same time, sometimes it's better to just invert your strategy. So if you're really losing a lot, like, just give this a shot, see what happens. Because there is a way of when you click a button that there is a right and wrong direction. So you just need to find which one that is. All right. Now on the winning side, let's go through here. All right. Why did you win? This is a little bit more meta, like, why did I win this trade? It's like price went in my favor, price didn't go in my, like, price went up enough or down enough. Like, that's sometimes gonna be very obvious, but really it's, was your stop big enough? Okay. Or really, was your stop too big? I could say this a little bit differently. Sometimes I see this a lot. I'm better about this than I used to be, but I'm, every once in a while I have my moments where I get into a trade and my stop is set at a certain point, and my stop is way too big for this trade. Like it's 12 points and I'm looking for like 6 points of profit, or it's 12 points and I'm looking for like 4 points of profit. Like it doesn't even make sense sometimes. And so if your stop is too big, or maybe it's not big enough, if your stop is too big, let's go with that. What can end up happening is you have an artificially high win rate, but when you have a loss and a loss and a loss, like it tanks your entire like strategy. Okay, so sometimes your stop could be too big. Let me just say it like this: was your stop too big? No, we'll get rid of the enough. Okay, was your stop too big? That's a better way to put it. Was it actually too big? And like, did you allow for too much movement before getting to your take profit? And here the truth is like if you're using a 1-to-2 reward risk or risk reward, so you're using a 2-to-1 risk reward. So for every trade I take, I risk 2 to make 1. You can have, as long as that ratio stays the same, you can have as big a losses as you want once you don't blow up your account. So that's not really the point. More so like, is your stop way too big for the amount of profit you're going for? Are you out of alignment with the ratio that you said you wanted to follow? All right. Was your take profit too close? This is a huge one too. Sometimes you'll have a strategy that does win, okay, like 51%, 52% of the time, or 34%, or 67%, but there's way more profit out there for you that you didn't capture. And so sometimes your take profit can be too close. Like this could be a case where you use like a trail, or you modify your strategy and say, you know what, when I trade during this time, instead of going for 10 and 20 or 10 and 10 or 20 and 10, I should go for like 30 and 15. I should go for 15 and 15 or 30 and 30, like whatever it is. You should expand your take profit because there is more out there for you. I would say this is the least, like this doesn't happen as much. However, you don't need it to happen that often. Sometimes when you have huge market movements and you're involved in these trades, if you just got a larger slice, that could change your entire week or month's P&L. So this is something I'm working on as well, like getting better at this, because there are trades that will account for an entire week's worth of profit and they happen in literally seconds. So sometimes like if you want to take profit too close, that can be the case, and that can keep you from being more profitable than you maybe already are or not. Let's get this out of the way here for technology. Ooh, bro, how do I get rid of this thing? It's like not moving. 1 second. All right, so same thing as before, like was there more room for profit? If so, how much? One thing about this, you think about it, it's like, okay, how much more? And then was it consistent? Or is it consistent? Is it consistent? Hello. And what I mean by this is like, let's say every time you get into a trade, not every time, but like 30, 40% of the time you get into a trade, like there's an additional 5 or 6 points out there. There's an additional couple dollars out there that you could have captured that you just didn't. If that consistently happens, then like you are leaving money on the table. That could mean that your risk reward could go from like a 2 to 1. So like you have 2 wins, and for every 1 loss that you have, or you make $20 for every time you lose $10. You can move that up to like 25 to 10. You can move it up to 30 to 10. You can really like expand how much money you make. So like how much money are you leaving on the table every single trade? Sometimes it'll be a point, sometimes it'll be 5 points, it could be 10 points, it could be 25 points. I don't know. But how much are you leaving on the table? And then lastly, like did the trade reverse after your entry or keep going, or after your exit rather? After your exit. I need to say this better. Sorry. So after you exited the trade, did the trade keep going, or did it like reverse down? This is really important to know as well, because if it reversed, you have a strategy that's getting at like the very end of these moves, which is fantastic. What that also means is that if you have a strategy where like you're getting into a trade and it wins, that you probably shouldn't take the very next trade that you see as well, because if you're getting into trades right as the trade is like over, that next trade is probably going to be a loss. You're going to get that money back. Other thing would be like, let's say you're getting into trades and you're getting into wonderful trades, like you're getting into like beginning of the move trades. Then what I would do, or I consider, is going from like day trader to like a little bit more intermediate. So instead of looking for a few like minutes of a trade, you're looking for like maybe 10 to 15 minutes, because you're getting into trades really early that turn into these humongous trends. And so it is really important that you consider, like, when I got out of this trade, what ended up happening? Was it just pure choppiness after, which is fine? Then like I shouldn't take trade after trade after trade. I should wait a little bit between my trades. Or like when you got out of the trade, the move was just beginning, and like you actually could have made a ton more. So these are all considerations, but this is how I think about building like profitable strategies, is everything that goes into this thing. I don't know if I can make it any smaller than that. Well, actually I can't. All right, this is all that I consider. This is all that I take into account when I'm looking at building a strategy. And this is really just the beginning. Like we're talking about 1 and 2 confirmations, nothing more than that. We could go way more in depth in this, but to begin with, build your strategy. Okay, decide which type of trader you want to be. Do you want to be a scalper? Do you want to be like a true like swing trader? That's great. What type of like risk reward ratio do you want to follow? I always start with a 1-to-1. That helps me see what this strategy actually is. With a 1-to-1, if it's close to 50, then I can try to go 2-to-1 and go for that 34%, or go to like a 1-to-2 and go to that 67%. Like start with a 1-to-1 and just see kind of how it works out. If it's like 55, 56%, then like you've got a really good strategy. Like just go ahead and scale that. That's number one. After that, like stick with it for 2 weeks, which we kind of talked about before. And then play with some of your take profits and stop losses. Adjust them around, play with the different ratios, 1-to-2, 2-to-1, 1-to-1, like play with them, understand them, and then review every single trade. You get into like 10 trades a day. It's really not that much work. Like, was this trade a good trade, a bad trade? Should I have inverted it? Was my stop too close? Was my take profit too far? Was it too close? Like, did the trade keep going? Did it reverse on me like after I got out? What happened with the trade? Because you'll start to see these patterns, and once you get the pattern recognition down, then you can go in there and you can actually like improve your strategy with some real things. You have a secondary confirmation that's even better or worse, or what you could do is take your strategy and say, you know what, during these times of the day, I win way more here than I do here. I'm not going to trade this anymore. I'm just going to focus on this. All of a sudden, that win rate goes way up and your profit goes way up as well. Okay, so review your stuff. If you have questions, you can reach out to me. Just ask me, hey, this is kind of what I'm doing. This is kind of what I'm seeing. I'd rather you guys DM me than comment on YouTube. It's a little bit harder for me to comment back with like a full explanation because it's just kind of not built for the platform. But anyway it goes, this is how I think about it. If you guys have other comments, questions, or like I disagree with it, then like let me know. But thanks for watching, and I will see you in the next one.